Good morning. This is Jim Colburn of Commodity Research Group. I'm here with Andy Lebow, also of Commodity Research Group, and we're here to talk about energy markets. To learn more about us, you can check out our website at commodityresearchgroup.com, where we post our podcasts and blog. We'd like to thank our friends at EKT Interactive Oil and Gas Training for hosting this podcast. Check out their newsletters, podcasts, and learning modules at ektinteractive.com. This podcast should be construed as market commentary, merely observing economic, political, and market conditions, and is not intended to refer to or endorse any specific trading system, strategy, or recommendation. We are not responsible for trading decisions taken by anyone. Information is not guaranteed to be accurate. This is not an offer to buy or sell any derivative. Today is February 20th, a little after 11 a.m. New York time. And Andy, I'm not sure. There's a lot going on. I'll give you a choice of where to start. We could talk about Middle East tension, OPEC plus policy, China demand, U.S. oil supply. Why don't we start there?
Okay, I'll pick door number four then. Let's
Okay.
start with U.S. Crude production. Always a good place to start, and a key variable in global markets, no question. Currently, crude production, which dipped a lot in January from 13.3, down into the low 12s because of the freeze outs, has now rebounded to 13.3 million barrels a day. Now, what's interesting is that the EIA is saying that U.S. crude supply is going to decline from here on out in 2024. They have 2024 production at 13.1 million barrels a day relative to where we are now at 13.3 million barrels a day. And that one is really hard to justify. In fact, I think that number is going to prove much too low. The market has now rallied back. Even the back of the curve has rallied somewhat. And I think we're going to see, certainly Exxon didn't buy Pioneer to reduce production, and Chevron didn't buy Hess last year to reduce production. You might see some independents try to say, yeah, we're going to maintain discipline. But Jim, I can't imagine that U.S. production is going to decline from here on out.
All right. What do you think? What's in their model that is predicting that? Do you think it's based on price, rig counts, all the above?
Yeah, I
Like a
don't have
lag price?
Yeah, maybe a lag price. Maybe they look at where the investments are. They certainly look at where rig count and the drilled but uncompleted wells are. And certainly the depletion has got to be in their model. But as I said, it's really hard to see it coming off. Particularly, I think, well, Permian is I think is still bound to grow this year, and we'll see what happens in the Bakken where Hess is really strong. So I would. Then I just saw an article actually about Bakken production looks to rebound this year. So I think the number is going to be rather than 13.1. I think it's going to be closer to 13.4, 13.5, something like that.
So is it? Can they? This number that 13.3 is off of the weekly numbers, and it gets
Right,
revised
right.
with the monthlies. But do you think it's actually 3 point? Can they bring back? I mean, there was almost 1 million barrels a day lost. Can they bring back that much that fast?
Yeah,
Do you
yeah,
believe you like that number? Is what I'm saying.
yeah. I mean, maybe it's 13.2, but yeah, they came back pretty quickly. So I think, and there was other growth in that besides the return. So yeah, I think the 13.3, 13.2, 13.3 for right now is correct.
And speaking of the freeze, what's the status with refineries?
Well, that's a big that of course has been a major factor in this rally back up from 70 to almost 80 today on the nearby and expiring March, because there's been unbelievable strength in the refined products. Cracks really rallied sharply, both diesel and gasoline. The diesel crack almost got up to $50, which is unbelievable. And the reason is that refineries not only are taking fairly large turnarounds in February and March, but we lost a significant amount of refinery capacity owing to the freeze outs. And some plants just, some of the management said, all right, well, we'll take the turnaround. So, we've seen runs go from before the freeze, they were running at like 16.6, and or maybe not that high. And now they're 14.8 million barrels a day. So,
So
they've that's really, that's really come off, obviously. And we're not making enough diesel or enough gasoline right now.
with the can you talk about crude oil structure? Crude oil rallied as well, despite, the crude production coming back faster than the
Yeah, I
runs.
think it was right. And I think it was dragged up somewhat by I think that you had somewhat, what should have happened. The cracks rallying makes a lot of sense,
Yes.
right? That you could get. And by
Yes.
the way, the crude run number is 14.5, not 14.8. So
Okay.
down significantly. But getting back to the cracks, yeah, they should have rallied because we have refinery issues. What is not quite, what doesn't quite work, Jim, is that the market has gone big backwardated.
Right.
It looks like, there's the March is expiring today. That spread went out. What did we see? 130
No, it's higher than that.
over. I mean, something's, who
Yeah.
knows what's going on exactly in the March. But that should have flattened out
Right.
and not gone backwardated. So, that one's a little harder to explain. And if you look at where crude inventories are, at least in the US, they're running around normal. There may be like half a day supply over the 5-year average.
So
So all that leads you to believe that the curve should have been flat, but it isn't.
it isn't. And it's also the same thing in Brent as well. We've seen a strong curve,
Right, right.
right?
Brent is saying strong, and there too, you would think that, one of the big things in Europe is that Russian products have been, because of the drones being hit, the Ukrainian drones, the Ukraine is going after Russian petroleum assets,
Hmm.
and they hit a couple of refineries, and they hit, which has tightened up the diesel somewhat, as well as gasoline. But you'd expect that exports of Urals, or it doesn't go to Europe, but if you look at a broader picture, you'd expect more Urals to be out and that the curve would flatten, but it
Ah,
hasn't.
right. Right. Yeah. So, it's interesting to look at what we read and what we see. It doesn't always work out. Although the IEA pointed out something about stocks on land, stocks on the water, and maybe you could talk about that as well.
Yeah, and that is probably, if we look at stocks on land, they said at the end of January there was a massive draw, and that stocks on land were the lowest since 2016. So that you would think, okay, I could take that and argue for, certainly you would argue for a backwardated market, and that's got to be, that's got to be it. Stocks on water, though, were growing certainly because of some of the issues in the Red Sea. with ships having to go around Africa. So you could see stocks on water growing, but meanwhile, stocks on land have been drawing. And yeah, maybe that's why you're more than maybe. I mean that's possibility as to why Europe or Brent has gone so backwardated.
Yep, I'll be interested to look at the U.S. exports to Europe. I wonder if that's going to pick up as well. Like, maybe that's what's caught because now Brent's got a little bit of was it Midland crude in their formula.
Right.
So maybe we're seeing some more this, maybe recent more exports of U.S. crude oil to Europe. I don't know. Interesting. Earlier this month, CEO of Oxy, Vicky Holub.
Vicky Hollop, right.
Yeah. She said she was quoted as saying in a couple of years' time, we're going to be short on supply. Why don't you comment on that comment?
Well, you know, there's nothing like a CEO of an oil company talking her position. I mean, it's it's great to it's great to hear, particularly if you're an Oxy shareholder. You know, it really flies in the face of some of the thinking about 2025 because already, there's a lot of chat about how horrendous 2025 is going to be because there's going to be all this new non-OPEC production coming on, and OPEC is going to be unwinding their production cuts. So you already have a lot of hand-wringing about 2025 and beyond. Oh well, 2025 and maybe into 2026. But I guess she's looking beyond that to the end of the decade and is hopeful that some of the investment money that wasn't spent earlier this decade will lead to a tightness in new supply. But there's been a lot of gains in offshore supply. So, I'm certainly, I'm not sure I bet all that much on what Vicky Holub is saying. But again, she may not be wrong.
Right. I mean, you don't see it in the curve, right? I mean, you don't see
No, you don't see it in the curve. You
yeah.
definitely don't see it in the curve. I mean, the cows back there are much cheaper than the 2024 cows.
Yeah, and I guess it was a couple of years ago we had that drumbeat of you know lack of investing is gonna when these oil companies started getting disciplined, people were talking about we're gonna have a shortage and then a year out, and we actually saw people putting money down and you know lots of out of the money options upside were bought to play the coming shortage of crude oil due to a lack of investment. And if I they may have been bailed out by the war. I'm not sure, but it didn't quite. It moved up. The prices moved up, but not quite as people were expecting. So, but we're not seeing that now either. So nobody's not quite reacting to that. So we usually have this we try to have this podcast after the big three, OPEC, IEA, EIA, come out with their monthly oil reports and discuss the differences or the numbers you disagree with. But if there's one word that comes out of this is pretty much balanced.
Yeah,
Why don't you
yeah.
comment on what you saw?
Now, if you look at the the big three, OPEC, EIA, and the IEA. Of course, we don't know. We're not going to know where OPEC production is, so that's a guess. The EIA puts out their guess, and they see rising OPEC production. But if you look at the EIA numbers, they have a big draw in the first quarter, and then the second, which I tend to agree with, and then the second, third, and fourth quarter, they have like up zero point 0.1 million barrels a day. That's zero point 0.1. So for the year, given that there was a big draw in the first quarter, they're down 0.11. So balanced, as you said. Looking now, OPEC is not. OPEC has big demand gains. I don't know where how they're seeing it, but they have a 2.2 million barrel per day demand gain over last year. And if you put all their numbers together and use, best guess as to OPEC production, they've got a draw of 1.4 million barrels a day for the whole year.
Oof.
So that's pretty bullish. Talk again, talking about your book,
Wow. Yeah.
pounding your book. If these OPEC numbers are right, it'll allow a quicker unwind of the cuts. And the IEA two, actually, they don't have much of a draw in the first quarter. But if you look at all their numbers, they have a draw of around 300,000 for the year. So a slight draw. Actually less than that. I'm sorry, 100,000. So again, balanced. Everybody's looking for balance. And CRG, our numbers, we've got a draw of 600,000 in the first quarter, and then slight draws in the rest of the way for a yearly draw of about 250,000, which is nothing. No, it's all balanced,
Right.
which is why I think that the market is we're in this 70-80 range, and
Well, it's
there's not a lot of enthusiasm on trading crude right now.
yeah.
There's a lot that can happen, obviously, but
We're well, we're commodity guys, and we don't think about comment like saying the market's going into a new normal. That's kind of like we think about a new chaos. So last month I was giving the EIA a hard time because they had their price forecast. It has you have this straight line going out for 2 years, and I said that that's not going to happen. But so far they're right,
I
and
know.
the volatility in crude oil on October 14th was 44 and a half, and on Friday, the first 2 months settled at 28. And you can think about all the crazy headlines we've heard since then, and this market has just gone very quiet from an option standpoint. So
You
it's
know,
yep,
I think, Jim, that the action has been on in refined products.
right.
The cracks, the curves. Although
Yes.
there's action in the crude curves, but I think the real money, if people had it right, has been on the refined product side, because those are moving. But crude is contained in this range.
Yeah, it's definitely showing up in options in other ways. When I looked at the outstanding or the top like open interest strikes in Brent and WTI options. There's strikes that built their open interest a while ago. So the top call for Brent is the 110 call in June. It's got 49,000 open interest. That's a good number, but it was put on. I can't even tell. It was a while ago.
Yeah.
Uh, you know, and then June 100 calls got is 33,000. June 85 calls 32,000. So these have been on for a while. And WTI has one of those wacky 50-cent call strikes in May, 76 and a half, 77 call spread, 61,000 open interest. That's a huge number. People were doing these a lot, over a year ago. And I'm not sure, I didn't see this go, but I'm pretty sure it's been on for a while. And then the one behind that is the DC 250 call at 24,000. So when the heck was that put on? So,
Oh man.
and then you could puts the same thing there. In Brent, it's the June 75, 70, 65, 60 puts. In WTI, it's the June and D60 puts, the D55, 65 puts. And those are small open interest numbers. So I'm not saying it's not trading. It is. It's just it's got that balanced look to it, basically. the paper flows all over the place. However, we have seen this decline in vol that I mentioned. That's probably the biggest story is that the EIA was right. It's balanced.
There's a headline right there.
Yeah, no, I mean,
Yeah,
eh,
it was right.
yeah, I have to be careful because I'm not putting down their intelligence. I'm just saying
No, I know.
it's
No,
really
I
hard to
know.
do. It's hard to do with it,
It's impossible. It's very difficult to do.
and they're also going against the grain where, like I said, as a commodity person, you have a little PTSD built into you where or some kind of nervous tick because you've lived through some of these crazy markets. And you take it day by day. So, it's like, oh, we're in a new normal. I don't think so. Um, don't get me going on value at risk, Andy.
Uh,
Uh,
we'll skip that topic for now.
we'll skip that topic for now. Okay, so let's talk about China demand. Somebody asked me at a dinner a while ago if I thought we were going to see a super cycle in commodities in this year. Like it was late last year, and I asked him, "What do you think of the Chinese economy?" And he said, "I don't think it's going to do much." I said, "Well, then I'd say you answered your own question.
Right.
Would you say that's
I think that's too much. I think if it shows, some the growth expected, I can't remember off the top of my head what the IMF was saying about the China GDP, but obviously they've had a lot of structural issues. And last year they came up with a decent demand growth. The IEA has them. They were way up on Chinese demand. I think we were up. CRG was up 1 million. I think the IEA was up 1.5. But a lot of that was comps. The comparisons to
right?
uh, 2022 when they were still in lockdowns.
Right.
So the demand that yeah they had a good demand growth, but that's because 2022 was so crummy. I think 2024, I think probably get 500,000 to 600,000 barrels a day, maybe slightly more than that, but I don't think it'll be a BAFO year in on Chinese petroleum demand. Now yeah, and they've done this throughout the years. They've done a good job of trying to trade really in terms of when the price is high, buy less, when the price is low, buy more. And they've been able to do that because they've got a decent amount of they've got enough inventory to play it that way. So another reason why the market has been contained in this range. They certainly bought less when the third and fourth quarters were making new price highs.
Hmm.
And maybe I think they bought a little bit more, when WTI was dipping down into the low 70s and Brent was also into the low 70s. So they've done a good job in managing inventories and to a certain extent, managing the price risk.
And what do you want to say about OPEC plus policy going forward?
Well,
And
they've got a meeting coming up in March. I get the sense there's not going to be any big changes for second quarter, and it's going to be the next meeting maybe in May or June after that when they'll see if they can unwind some of the price cuts. Demand may be strong enough to allow them to do a little bit, a tiered on type of unwind. They're in terms of who's cutting and what the market's not expecting them to comply to all their cuts, and they haven't. There's been some cuts from Kuwait, of course, but Iraq, UAE, a little bit slower on trying to comply. The wild card, of course, is Russia. That they may be able to comply on the totals because they may have more crude for sale. We'll see. We'll see in the next couple of months. But I think I think the Saudis are canny enough that they know they can't do all they can't unwind their 1 million barrels a day right now. The market's certainly not there. Maybe if they could see the market get up to into the mid 80s to 90, they can start an unwind.
Interesting. There's a story in I think the Wall Street Journal today about how the Saudis are needing cash for all their expensive projects that they're spending money on.
Right.
And
So they don't want to see the market. They don't want to see Brent, in the low 70s, high 60s. That they certainly don't want to see. I think they could live with 80, 75 to 85, something like that. And then amongst some of the other OPEC countries, we'll see if the U.S. tightens up sanctions on Iran. There's been a lot in the press lately about how we've sort of allowed Iran to export more, and Venezuela. We'll see if we're trying to loosen the sanctions, and now they're massing troops on the Guyana's border. So we'll see whether or not and Ven production has been going up a little bit. So we'll see, whether that gets tightened. And there's always Libya as to, they had production cut in January, December and January because of the strikes or I don't know, because of something because of their usual issues in Venezuela between the two governments in the east and the west and the NOC in Libya. So they the surety of supply coming from Libya is certainly not great, and that's an understatement.
right, I think about Venezuela troops on the border. I'm thinking, what's the policy there? They want to take over the production of Guyana and turn it into zero. Is that what the deal? So that's what they did with their own stuff, right?
I know,
Yeah,
I
I don't
know.
get it, but
Well, they say that
no,
there's a disputed land,
of course,
which they claim is theirs. Of
yes,
course, some of it has the oil. I don't think there's anything going to happen, but you know, there's something that it's an event that could happen.
it could happen. That's right. That's why, yeah, I walk around nervous about the markets all the time. I'd rather be an option buyer in oil and seller if I can, and that's because all this stuff that you just
Right. I
sleep better at
mean,
night.
we haven't even spoken about the Middle East.
Well, that was the first thing I mentioned with topics for you to pick, and let's talk about that. The Red Sea stuff is flowing through, but stuff is also going around. I think Wood Mackenzie had something out that said 20% of oil tankers are using the long route.
Yeah, I think that's about right. I think that's about right. Let's say roughly 2 million barrels a day, something like that. 1.5 million to two, maybe more. So it's definitely had an impact on shipping costs, and there's been dislocation, and despite the U.S. bombing of in Yemen, and in Iran, the attacks. There was one. What was it? Friday? There was one 2 days ago, which the crew had to abandon ship.
Mm,
So that doesn't look like that's not changing. I mean, it doesn't look like it's quieting down any. And of course, Israel's dealing with Hezbollah in the north, and they're threatening to invade Rafah. So we still haven't lost any supply, and hopefully things quiet down somewhat there. But
right.
it's still a factor.
It's a day
Big
by day
factor.
thing. Yeah.
Yeah, it's a day by day thing.
Cargo by
Exactly.
cargo.
Yeah,
Which would you rather be right now, an oil producer or an oil refiner?
I would rather be a producer because the all this capacity is coming back, and there is new refinery capacity in Africa. There's a giant 500,000 in Nigeria. There's a giant 500,000 barrel a day refinery opening up in the Middle East. There's more capacity, and in China more capacity. Both probably more next year than this year, but there's growth in refinery capacity. And the other thing is nobody wants to buy a refinery. They'll build them like in the U.S. Refiners have been trying to, the Houston refinery, they've been trying to sell that for years now. And, there's no buyers. So they're just going to close it.
Mm,
So, I think I'd rather be a producer. At least you could sell your company. We're seeing all this,
right,
we're seeing all this consolidation and, there's value there.
right. This energy transition is very interesting, and I just wanted to ask you, as an analyst, you contend with, EV sales cutting into gasoline demand, and then on the other side of this is increased hydrocarbon demand, I guess mainly for plastics, but other things as well. So many things are made with petrochemicals. So on the one hand, you have a sharp increase in demand. On the other one, you have one that's tailing off. How do you deal with that in terms of coming up with your numbers?
Well, a lot of it is guess as to what where EV sales going to be this year. Well, last year I think they were 1.2 million, and this year there's expectations that it's going to be 1.6, 1.7 million. So, that just back of the envelope stuff, you're losing 100 to 150,000 barrels a day of gasoline demand, something like that. And of course, globally, we've seen tremendous growth in China, but what's been interesting is there's definitely consumer pushback from EVs. So, on the EV front, in terms of range and colder weather and being able to, well, range and colder weather plus not enough charging stations. So it's possible that we don't meet those numbers, and certainly it looks like the bigger trend is that the transition is backing up in terms of it'll take longer, which you and I knew. We've talked about this for years.
Yeah, and I guess Toyota had this idea that hybrids would be a better way to go because you sort of maximize the use of the metals across wider range of cars that would kind of be in operating more hours and stuff. And I actually have a hybrid, and it's really nice because I don't have to depend on our energy grid, which is being taxed more and more because they are pushing to be really green, and they want to, at the same time, they want to electrify everything. So it's really hard to get that balance right. And so far so good. We haven't had interruptions of power through some major storms, but it's going to happen more and more. And in the wintertime, New York put a big push to get people to install heat pumps, and I look at which I did, and I look at my electric bill, and these things use a lot of power during the heat, not during the cooling times. During the winter time, they use so much electricity, and if you're if you're charging a car on top in the cold weather, you're putting a lot of stress on the grid. So it'll be interesting to see how this all turns out. Andy, just before we wrap it up, I just wanted to mention, that I mentioned the option flow looks kind of like a normal or a balanced market. It's not so much in natural gas options. I posted something on LinkedIn last week or on Saturday, and it basically shows that we're in this free falling natural gas market, and yet the option skew is flipped. So it's kind of like it's gotten very to the bullish side. So skews to me, they're not really meaningful. They each market has its own skew. Crude oil is tends to be, put put volatility is over call volatility. If you look at a 25 delta, I think the front month's like -3 right now, call over, oh, I'm sorry, put over, and then you go out to December and it might be -5. So where natural gas can be the opposite. And uh, anyway, that's flipped. So I just want to see today we're down. I want to see if we're close to reaching a bottom here. So keep an eye on that.
Yeah, that
Any,
move
yep.
that move has been unbelievable. That move has been incredible.
Oh
You
yeah.
know,
Y-
the
Yeah.
nearby was, I don't
It's
know, over $3 just as we went into the freeze, and now we're $1.50 something.
Yeah, it's relentless on the way down, and we'll see. There's a lot of heavy volume. It's not one way, but like I said, there are more puts trading than calls, but the open interest is going up in puts as well. So it's not 100% liquidation, but we are seeing, like I said, the skew has kind of flipped to the more. It has a more. If you just look at the option, you say, well, this market has a little more bullish look to it. I'm not saying the skew is an indicator. I just look for times when things are different than they have been recently, and that's the case. Anything else, Andy, you want to include in this month's podcast?
No, I think we've covered a lot. There is a lot going on. The
Yes.
market is been in this range, but still, as we mentioned, the product markets, and you just mentioned the natural gas market, which has, really been the one-way move down, one-way move down after a one-way move up.
Right.
But yeah, there's certainly a lot to be paying attention to in this market.
It sounds like you expect more of the same. You're all balanced, and so to me, that's maybe if it's slight draws, maybe a grinding sideways to slightly supported market going forward.
Yeah, that's what I mean. I think we said that for the last podcast,
Yes.
grinding sideways. The market did get hit on false rumors of a ceasefire, and also I think concern about whatever the concern about the economy, whether or not the Fed was going to cut, brought in some speculative flow from the downside, and that flow was wrong actually
Yeah.
in retrospect.
Wow. It's listen, these are tough markets, but
Yeah,
economists this is not their better days.
definitely not.
We didn't get the recession. I'm wondering, do we get a recession now that everybody's on board for growth? So I always try to think of what's the most sort of the least expected outcome. So when over a year ago, our other partner, Ed, we were talking about, well, the only thing that people aren't talking about is strong growth with declining inflation. And we
Right.
weren't we weren't predicting it. We were just saying this is what we're not hearing as a possible outcome. And that's what happened. And now the outcome would be that the Fed actually raises rates before
I
they lower them.
There was just an article,
Oh
I
no, really?
think it was in Bloomberg or the Wall Street Journal,
Oh God.
something about, the if you look at the options markets, that there's a chance that they rate actually raise rates.
Oh
That
good.
that's that
Yeah.
that's that's creeping in.
Great.
Great, right.
Yeah. Yeah. Okay. Thank you very much, Andy. Do you want to tell people how they can get in touch with you?
Yes, you could reach me at a Lebow at commodityresearchgroup.com or through our website, Commodity Research Group, and LinkedIn.
Yeah, I do I do more stuff on LinkedIn these days. So if anybody's interested, connect with me on LinkedIn, and I post some articles or things that I like, and the podcast will be up there in probably by later today or tomorrow.
All right.
Until next month, Andy.
Till next month.